What's up, everybody? I'm really sorry about that. There was the Palantir Live. I was covering Palantir, and it was supposed to be at 9 a.m. I guess I messed up, and it was actually 9 Pacific time, which means that it just started, so it was running a little bit late. Yo, what's up, Nate? I appreciate it. Thank you so much. Sounds good. Yeah, we're in, guys. We are in right now, and let's see what's going to happen. Let's see the Federal Open Market Committee. It definitely looks like it's going to be 25 basis points. We'll see what ends up happening. What do you think is going to happen? What are you guys looking forward to? Do you guys have any predictions? What do you think is going to happen with stocks? What do you think is going to happen with crypto? So just for you guys to know, let's recap this. Let me pull this up 1 second. FOMC. Let me just show you guys something. I want to show you the minutes. 1 second. FOMC events, press releases, calendar, payments, financial survey about the Fed, data. Massive crash. Bro, what are you talking about? What's 75 basis points? There is zero chance it's going to be 75 basis points. Zero. I can't imagine it's going to be 75 basis points. It's 99.5%. I think the chances are that it's 25 basis points, and maybe they'll do 50 if they really do want to crash the market. But, I mean, I can't really see them doing that, right? Like, I really can't see them doing that. We'll see what's going to end up happening. But this is what I wanted to show you guys. 1 moment. PDF projections. All right, I wanted to show you guys this. Present share screen. Boom. So this is a very important indicator. This is what they projected. So this is their median projections. So they're saying that it's going to be 5.1%. They're saying that the federal funds rate is going to hit 5.1% in 2023, and then it's going to come down to 4.1% in 2024. However, this 5.1 actually came up from 4.6. So in their meeting from September, they said 4.6. Then their meeting in December, they went up to 5.1%. So let me just zoom in on this in case you guys don't see what I'm talking about. I'm looking right here. So it's very important to see that they believe that this year we're going to get 5.1% inflation, a federal funds rate. Federal funds rate at 5.1%. So it's definitely going to be very important to see what's going to happen. But I don't think they're going to hit 5.1%. Honestly, if inflation keeps going down, then I don't see that they're going to end up raising to 5.1%. I don't see that happening. We're going to end up seeing what's going to happen, but I don't think that this is going to, this is what's going to end up happening. And they also foresee that the unemployment rate is going to go up to 4.6%. We'll see what's going to happen over there as well. Yeah. And I'm looking forward to seeing what's going to happen. The markets are reacting positive so far. Oh, what's good? How you doing, True? Lefty, yeah, I think it's going to be 25 basis points as well. I hate to say it, but things are going to get obliterated. I feel it's only a matter of time. So I think that we are hitting a recession, like not just a technical, but we're going to have a recession. How deep? I don't know. I do think there's going to be a pullback for crypto. I do think there's going to be a pullback for stocks. But the next pullback that we're going to have, I'm going to go heavy. Like after the next pullback, I'm buying. I think there's going to be one more pullback. If it happens or not, I don't know, but that's my personal prediction. And on that next pullback, I'm pulling the trigger. I'm going to buy. Let me see what's happening right now with a couple of cryptos. Let me see right now. I mean, crypto is reacting pretty good. Crypto's reacting decently. All algo is locked up in governance. You could get out. There's no penalty for getting out of your governance. You know, all you got to do is just withdraw it. You just won't get a reward. None of the Fed moves make any difference in the medium or long term. None of them. I don't know if that's true. The Fed's moves is what dictates Treasury bond yields, and Treasury bond yields is what dictates mortgage rates. So I don't agree with you. I'm not saying you're right. I'm not saying you're wrong. I don't personally agree with you. How can you say that the Fed's moves of raising or lowering interest rates have nothing to do with the medium or long term? So if the Fed is lowering interest rates, it's not going to make a difference? I don't get it. And then at the same time, their movements, the Fed's movements is only short term. The movements are, meeting to meeting. They have 10 meetings a year. So that means that every meeting that they have is short term. There's nothing the Fed does that is long term, right? Does that make sense? Marcel, what's up, my love? Market is dumping hard. Is it really? Cheaps is here. Short term doesn't matter for myself, here for long term, so accumulating till. Yeah, man, for sure. For sure. Interest rates are everything, like the federal funds rate is what dictates all other interest rates. The federal funds rate gives to prime banks, alpha banks, then it trickles down. So the federal funds rate is what establishes all of the funding that we get, all of the lending that we get, so on and so forth. You understand what I mean? Like, that's what it is. I honestly thought that there's going to be a run-up until the Fed. I made a video about this, and I wanted to get out of a lot of my crypto. I did not. I'm an idiot, a schmuck, and it is what it is. So now I'm really hoping that the market keeps going up, and I'm going to have an opportunity. For staking long-term holders of crypto, it means nothing. I don't know if that matters. I don't know if that's true either, bro. Like, that's such a short-sighted statement. It doesn't make much sense, because if you're staking your crypto, that's great. But if rates go up and it tanks crypto, aren't you DCAing? Aren't you buying more? So how can you say that it doesn't affect crypto? How do you say it means nothing? That's a very ignorant and naive statement. And I'm not trying to be contradictory here, but that is a very naive statement, right? Like, how can you say that it means nothing? Of course it means something. And if you are staking your crypto, don't you want to get more returns because you're getting paid in crypto? So if the value of your crypto goes down, that's also bad, right? Just saying. This was my plan. I was going to get out of like 50% of my position and rebuy later. I never did. I wish I did, but I never did. I'm at the point in my crypto journey, everything needs to stop so I can catch up. I can't even sleep. Let me see. James, good to see you. Which coin buying on this time? Interesting you should say. Guys, I have a second YouTube channel for cryptocurrency where I'm buying $50 of crypto every day. I'm buying tokens. I'm buying coins. I started a new series. The series is I have to buy $50 of crypto every single day. No matter what happens with the market. Up, down, does not matter. I'm buying $50 of crypto. Yesterday, I bought $50 worth of Gala, and I'm tracking it on an Excel sheet, and I'm going to be posting all of my information. If you want to watch what I'm buying every single day, let me give you guys a link to the video. So remember, it does not matter what the conditions are. I have to buy $50 of crypto every single day. Every day, I have to buy $50 of crypto, and I'm going to try to keep this up for at least the next year. This is the video down below, right here. That's the video down below. If you guys want to follow my journey, and I'm trying to get to $1 million, please feel free. This I agree with. Less meaning, I agree with. But no meaning, I cannot agree with. And maybe that's what you wanted to say. So less meaning for long-term holder, 100% I agree with you that for a long-term holder, long-term investor, not a trader of crypto, of real estate, of stocks, the rates don't mean as much. But I won't agree and say that they mean nothing. I cannot agree with that statement. Again, I'm not saying I'm wrong. I'm not saying you're wrong. I'm not saying I'm right, and I'm not saying that you're right. I'm just saying my opinion, they do mean something even for long-term holders. However, they have less meaning. I agree with you. Diversification is for the uncertain. I only buy H-bar. Well, that's good for you, but I'll tell you something. There's going to be a lot of high flyers in the next bull run. A lot of high flyers. And if you can have a bunch of different bags. So I have my core positions. I want to obviously increase my H-bar position a lot because I love H-bar. However, let's say H-bar goes up 5x, 10x, 1,000x. Doesn't matter. It does not matter. Whatever number H-bar is going to go up, there will be another project that's going to go up more, significantly more. It's just a fact. And you can interchange H-bar with Algo or Cardano or Ethereum or Bitcoin. You know what I mean? Like, it's interchangeable. You don't know which is going to be the project that's going to go 5x, 1x, 10x, 1,000x, a million x. You don't know. Like, so having a mixed bag is good if you want long-term success. One of the mistakes that a lot of people do is they FOMO into only one project. And although I agree you should have a favorite, I think you should also have a mixed bag, you know? And that's it. And that's not to say anything about H-bar. I love H-bar. I can talk about H-bar all the time, but I definitely believe that you should have a mixed bag. And that's why my second channel, I'm going to try to talk about buying $50 every single day of different cryptos. What sucks is I would not be buying crypto right now because I think there's going to be a pullback. However, I still have to buy crypto every day, $50. That's the rules. And after this live, I'm going to be picking a next crypto to buy $50 worth. I have to acknowledge that you and Johnny Crypto brought H-bar to my attention. Thank you. It is now one of my personal... My pleasure, bro. My pleasure. Okay, let's go back to FOMC. Okay. Let's go to the meeting today. Let's go 2023. Okay. And let's go to FOMC Twitter. Okay. I'm trying to get the numbers. Okay. I'm waiting, guys. I'm waiting. If you guys get the answers, definitely let me know. Let's share the screen, present, share screen. I'm trying to get the numbers, guys. Let's see. You know, and I just want to say one more thing. More important today is not how much they're raising the basis points. It's forward guidance. That's what we're looking for, the guidance. So, okay, if Jerome Powell is going to say something like this, yeah, we raised by 25 basis points, inflation is still not under control, that's one thing. But if Jerome Powell says inflation's not under control, we only got one or two good reports, but we need many more. Or he can say inflation is starting to get under control, I don't want to get overzealous, and I would like to see the next reports before we make a pivot decision. You understand? Those three comments is like bullish, bearish, neutral, right? I don't think it's going to be 50 because if you look at this, let me show you. So there's a tool, guys. Most people don't pay attention to this. Nobody cares about real stuff. So if you go to CME FedWatch, this is going to give you the percentage of what they think the rate is going to be. And right now there's a 98.7% chance that it's going to be 25 basis points. 1% chance that it's going to be 50 basis points. And yesterday, this number was 99.6. 99.6. So let's see what's going to happen. Guys, don't forget to subscribe. Can I please ask you subscribe to my channels? I got 5 channels. I also have a Discord. Can I please ask you guys to join my Discord? It's 100% free. I don't have a Patreon anymore. I don't get any funding. I don't have any sponsors. I wish I would, but I won't take any shit sponsors. I don't have a Patreon. I don't have sponsors. YouTube pays me like $250 a month between all of my channels. I kid you not. You guys see how much work I put into it. Please take a moment to subscribe. Take a moment to give me a like. Take a moment to help me out. You know what I mean? I would definitely appreciate it. And besides from my real estate, I don't really have any income coming in, and that's okay because I made money on my business. So unlike many YouTubers, I made money before YouTube. So I'm surviving literally on my freaking savings for over a year. So most YouTubers cannot say that. Most YouTubers cannot say I made enough money that I don't need to work for the next couple of years while I'm a full-time YouTuber. I get paid $250 a month, maybe $300 a month from YouTube. I don't have a Patreon. I don't have any sponsors. I'm doing this for you guys. So please take a moment to subscribe, take a moment to like, take a moment to comment to help me out. Yeah, man, I have a Discord down below. If you guys join the Discord, I would appreciate it. Not to mention, I have poker tournaments just for my Discord. I put up the money. You guys play for free. That's it. Nobody else gives these type of value. Abdullah, hamdulillah, baby. Hamdulillah. Let's do this. Let's do this. Okay, let's see where we at. Where we at? Federal Reserve, let's see. Let's see what we got over here. What we got over here. No tweets yet. Nothing yet, guys. Nothing yet. Let's see, let's see, let's see. Ba-da-da-dum, pam-pam. Look at the team of TX Schilling and... All right, what do we got? What do we got? What do we got? What do we got? PDF. 4.25. All right, 4.25. So they raised it by 50 basis points. What else did they write? Let's see the statement. Effective February 2nd, 2001, Federal Desk underlining open market operations is to maintain the federal funds rate in a target of 4.5 to 4.75. Conducted overnight reverse purchase agreement. Okay. The release approved of 0.25 percentage point increase. Okay. 0.25%, guys. 0.25%. 0.25%. That's good. How are the markets doing? Let's see. Yahoo Finance, and let's see this. How are the markets reacting? SPY is down. I have a feeling that this is going to come right up if I'm tracking this live. Okay. And let's see the QQQ. Okay, that looks good. And how is Palantir doing? Palantir is doing good. And let's see CoinMarketCap. CoinMarketCap, let's look at the charts. And it looks like it just jumped up, right? So it went from 2,300 to 2,380. So it looks like it started coming back a little bit, the market. Let's see. What am I missing here? Let's go back to Yahoo Finance. Palantir is still green. QQQ is down just a smidge. Down a quarter. SPY is down 0.5%. Going down deeper. Let's see. All right, so that's what it is. That's what it is. Do. Second. But 425 to 450, 450 to 475. What am I missing over here? 450 to 475. Yeah, what is this guy scaring me? What is this 50 basis points? It was 25 basis points. What am I missing over here? Am I missing over here? So it was 450 to it was 425 to 450. It was 425 to 450, and now they did 4.5 to 4.25. 4.5 to 4.75. Yeah, what are you talking about? It's 25 basis points. Guys, double check me. It's 25 basis points. What is this guy talking about? Am I losing my freaking mind? 25 basis points. Uh, 25. Yeah, 25 basis points. What are these guys smoking? Yo, you're smoking crack? And you on heroin. Stop playing. Stop playing with me. It's moving up nicely. Let's see. Oh, yeah, it went up. Okay, 1 hour charts, guys. 1 hour charts. 1 hour charts. Gala is moving. Da. Guys, what do you think I should be buying? What do you think I should buy for today? What do you think my $50 purchase should be today? What do you think I should buy for $50? Yes, it is 25. Good. Just bought more Algorand, Algo, troll. Yeah, he's a troll. Yes, 25. Yo, this guy gets me like mad nervous. So are we bullish? Well, again, let me just explain this. 25 was expected, okay? Let's reverse. 25 was expected. Right now, we're looking to see what Jerome Powell has to say in the next meeting. So in around 25 minutes, Jerome Powell is going to speak. He's going to hold a meeting. Guys, don't go nowhere. Jerome Powell is going to speak. We want to hear the speech. When Jerome Powell is going to speak, we're going to get a lot more information about what's going on. Don't go nowhere. Okay? Make some money on Hump Day. Is today Hump Day? So Jerome Powell has to speak today, and we're going to see what he says. We're looking for forward guidance. We're looking for his guidance of what he's going to say. That's what we particularly want to hear. Okay? Buy Stellar. Stellar is definitely going to be part of my bag, but I'm not going to be buying Stellar today unless I am. Okay, the problem with Atom right now is I like Atom. I don't want to buy it today because I want to show you something. If you look at 24 hours, where is it? 1 second. Atom was doing very good for... Here. You see, that's my problem with buying Atom today. Because Atom is in such a run-up. So Atom already went up 6% for a 24-hour period, and it's up 11% for 7 days. And since I must, for my series to get to $1 million on my second crypto channel, I must buy $50 a day. The problem is sometimes the market is good, sometimes the market is bad. So I don't want to pick crypto that already had a run-up. I want to pick crypto that at least didn't have a run-up for the last week. Does that make sense? And that's why Atom is not good. However, if I were to make a video about Atom, or I was going to make a video about something that went up like crazy, it would probably get a lot more views. I like Cardano a lot. I like the team a lot. And I think Cardano gets a very unfair... Cardano is a very... How do I say this? Good chain. It doesn't do anything amazing. It doesn't do anything bad. It's a good chain. It is also considered by everybody a super decentralized chain, if that means anything for you. Cardano is an old Generation 3 blockchain, and because of that, it takes a little while for Cardano to be able to upgrade. And it uses 2 coding languages, not 1, but 2. So you need to code in one language, and then it gets converted to another language. And this takes time, and it takes a lot of energy, and it takes a lot of effort. That's my issue with Cardano. However, if I show you this right here, guys, if I show you this right here, and I want to show you guys the top, one second. If I want to show you the top cryptocurrencies, I think for sure Cardano is going to be a top cryptocurrency, right? Right now, Cardano is trading at 38 cents. I cannot see it not go back up past $1 easy. I think Polygon is going to be up there as well. Polygon did very good during this downturn. And I'll be honest with you, if I see Solana take a shit again to like 16th or 17th place, I would buy it. I would definitely buy Solana. You know? Not because I think Solana is good. I think Solana has a lot of meme factor and they have a lot of backing. You know what I mean? I forgot. Oh, thank you so much. Don't forget to hit the like button. Thank you so much, Maytag. I appreciate it. Did you look at DJED stablecoins that came out yesterday? Nah, but why would I want a stablecoin? What's the point of it? Why would I use DJED instead of USDC? Let's see XLM. Stellar is right here. Stellar is down to 2. Let's see how bad Stellar is doing for the last year. 89 cents. It was at 22 cents. So it was at 21 cents, and right now it's around 9 cents. Stellar has a very interesting run-up, right? They have 2 peaks. Most projects have single peaks. Stellar has 2 peaks. 1 and then 2, right? And then if you go to, for example, let's go to, damn, ApeCoin is going crazy, bro. ApeCoin is freaking nuts. Algorand never had its peak. Algorand still did not have a peak, bro. Algorand never had a peak. It sucks. They never had like a bull run, if you notice this. They never did. Let's see, let's see, Cardano. Cardano is nice. I definitely could see Cardano go back to a all-time high. Why not? Basically, it's funny. When you're looking at crypto right now, all crypto can hit an all-time high, right? You can go back to an all-time high of 10x, all of them. That's what everyone thinks. I don't know much about it. I know it's a project on Algorand. I don't know much after that. NASDAQ is up. Let's see. Okay, let's do QQQ. Okay. How's Palantir doing? Palantir is doing well. Very good. Very, very good. Palantir is doing very, very well. Palantir did not have a bull run yet. They didn't have a bull run yet. It's going to be very, very interesting to see what they're going to do. Let me do a, what do we want to watch? We want to watch Washington Journal. just sign in with this. Let me sign in with Fed approves rate hike. Let's see. This is what they're talking about right here. So this is what's interesting. Yo, and don't let them lie to you. There was a recession right here. They're not showing it to you, but there was definitely a recession right here. Don't let them lie to you. Officials signal more increases likely. Fed officials are slowing interest rate increases as they debate when to pause. Officials noted in recent improvement in inflation. So I think that they're going to be raising the interest rate for the next couple of meetings. I don't think that they're going to stop, and I'll tell you why. So a lot of people thought, oh, you know, the Federal Reserve is gonna raise the interest rate by 50 basis points, which is freaking ridiculous at this particular point in time, because they want to crash the market. They can't do that. As long as inflation keeps going down, they can't raise by 50 basis points. What they could do is they can raise by 25, or they could not raise at all. I don't think that they're not gonna raise at all, so they have to raise by 25. By them raising by 25 basis points, that is them putting a stop to the market going crazy. Think about it. If they all of a sudden did 0 basis points, the market would rally like crazy. They don't want that. They're gonna look for a pullback. On the next pullback, that is maybe when they're gonna put the brakes on from raising interest rates in order to skyrocket the interest rates. I mean the market. And this is what's so scary, right? This is what's scary. So over here, when we raised the interest rate, this made us a huge recession, right? Right here, this left thing right here. And then we raised the interest rates, and then we had a huge recession, right? Right there. And then we had a huge recession. And right here, we raised the interest rates, kind of. And then we had a huge recession, right? Well, this was COVID. And then we're raising interest rates right here. There was another recession right here. They're not putting it here because they're saying, oh, it's not an official recession. It was a technical recession. But we definitely 100% had a recession right around right here. And now we're raising interest rates. So the question is, how high do we need to raise interest rates to see this recession right here? And this is the recession that people are going to suffer the most. Right now, most people that are getting fired are still from Silicon Valley, like a Google, a Microsoft, a Meta, stuff like that. Soon, blue-collar workers are going to get fired, like truck drivers and things like that. It's going to be very interesting to see what's going to happen. Let's see CNBC. Let's see CNBC. Let's see what they're saying. Let's go to YouTube. Let's go to YouTube. CNBC. Let's see what CNBC is saying. Caterpillar performance. Joe Terry explains why ETF drop a lot. You see, this is what I was saying. You see how you guys can't see. This is what I was saying right here. You see, this guy is saying North American CEO, there will be an upset in the market if the rate stays at 25 basis points or for longer. That's what I'm saying. The way to kill the market is to keep raising by 25 basis points. That's kind of how they're killing the market. If you guys want to listen to this, we could. 1 second. Share screen.
Welcome back. Joining us now on the market as we get ready to wrap up the hour is JJ Kinahan, CEO of IG North America. It's been a while, JJ. Welcome. Good to see you.
Great to see you, Kelly.
There is this huge debate we're all having right now. Is this rally a head fake or not? And how much is the Fed's decision today going to feed into that?
Well, you know, it's interesting, Kelly. When I look at our clients' activity, two things give me a real note of caution. The first one being Tesla, which, you know, I've talked about a lot before, in the fact that it's a real barometer of retail confidence. It was interesting to me the 2 days before their earnings last week and for the couple of days after, we saw a lot of bullish positions both in the equity and call buys. 70% of those people who opened the positions have closed them. I combine that with what saw yesterday in the fact that people buying puts in QQQ, so for those not as familiar with options, again, you buy puts hoping that the market will go down and you can sell them for a higher price. But in the QQQs, reflecting the NASDAQ 100, obviously, we saw almost 3 times as many people buying puts as we see on a normal day. I think that that's reflecting exactly the conundrum you guys have been, you know, discussing all morning. Is Chairman Powell going to continue with his 5% talk after, you know, we're at a 99.3% or 99.7% probability of a 25 basis point hike. So after that raise, is he going to continue with the 5% talk? Whereas the market, if you look at the probabilities, is pricing in one more 25 basis point raise and then sort of slows down. So there's going to be, I think, perhaps an upset in the market because of that. And it's very interesting to me that retail traders are already going towards that because they see perhaps an upset in there after he speaks.
So you think the Fed will win this round?
You know, the old Wall Street expression, never bet against the Fed. They tend to have a lot of tools and money at their disposal. And even if you think, you know, if you think they're irrational, they can stay irrational longer than you can stay liquid. So it's really, really difficult to bet against them.
All right, JJ, I have to leave it there. Unfortunately, thanks so much for popping in today. We appreciate it. Welcome back. Joining us now on the market.
Oh my God, sneezing is crazy. Guys, it's going to go on in about 10 minutes. Jerome Powell is going to speak. Let's see what he has to say. Let's go on to my Robinhood. 1 second. Let's go into my Robinhood account. And let's see how we're doing over here. Give me 1 moment. I'm signing into an account. Five, 7, 5, 9, 7, 3. Thank you so much. Thank you so much. Appreciate that. Long on rice, like rice? Is that what you're long on? Rice? All right. Stop sharing this. Stop. Let's do share this. Share screen. Let's do this. Okay, let's see where we are with the SPY. SPY is standing. So it jumped right when he spoke. Okay. It jumped. And now it's chilling. Let's see QQQ. QQQ is green, which is nice. And Palantir, I think Palantir is just going green because there's a lot of upside with the Palantir FoundryCon, man. And then you have the shareholder meeting in 11 days. Really, really big deal what's happening with Palantir. I'm really, really excited. Let's see what Bitcoin is doing. Bitcoin jumped. Bitcoin jumped from 22.9. Then it went all the way up to 23.08. And now it's at 23.40. So Algorand had a nice jump from 23 to 23.6. Okay. This was nice right here at 26. I thought Algorand could have gone to like 30 cents or something like that, and then it would have backtracked, but it never happened. So, yeah. What's Cardano doing? Cardano had a little pump too, and now it's just chilling right here. Guys, don't sleep on Ethereum too. Everyone sleeps on Ethereum, and I don't know why. Ethereum is not a bad play. People think Ethereum is boring, that you can't make money. Ethereum's a strong play, guys. Ethereum is definitely a strong play. Let's see. What are we doing right here? How's Tesla doing? Tesla's up a bit too. Tesla's up. Damn, 175. Imagine you bought Tesla at 100. Imagine you bought Tesla at 100. You would have been a freaking pimp. You would have been a pimp. Let's see. How is my M1 Finance doing? Let's see how the public portfolio is doing. 1 second. The day is not over. No, it is not. No, it is not. No, it is not. No, I don't want this. Continue without this. Continue, and then I want to do this. Give me 1 second. I'm just logging into one of my accounts. Give me 1 second. Fucking shit. Yeah, I hate having so many accounts to log into. It's really, really difficult. You forget your passwords. What is ANKR? What is ANKR? ANKR. NKR. What is this? Let's see what this shit is. Oh, it's definitely a token play, right? Mm-hmm. Yeah. This is definitely a scam. Anchor's app chain as a service. Anchor is a key infrastructure provider for BNB chain ecosystem. Their contribution, definitely. I don't know, bro. All these tokens are scams. I don't believe in none of them. Like 99% of these tokens are scams. Alright, whatever. I'm not buying Anchor, that's for sure. I'm not buying Anchor. Alright, he's about to speak in 6 minutes. The day is over. I bought Tesla at 109 and sold my shares at 150. Listen, you can't get mad. You made like 50% on your money, 40 something percent on your money. You can't get mad. That's a really good deal, you know? You made a lot of money. That's a win. Don't ever get mad about a win, you know? I expect them to come back down. Ether is going to hold. Check out Petrobus. Check out the dividend. Petrobus. Petrobus? Let's see. Maybe. You know what? Let me see. Let me see this a little bit better. Let's see what Anchor does. It's a small cap. Let's see. 130 million. Price is 14 cents. What is Anchor? Anchor is a decentralized blockchain infrastructure provider that operates an array of nodes globally distributed across the world, inflicted proof of stake network, and drive the growth of crypto economy while powering a full suite of multi-chain tools for Web3 users. Anchor provides a comprehensive blockchain developer solutions, APIs. Anchor earned. But like, what do they do, bro? Like, this sounds like every other crypto project. Like, what do they really do? What does Anchor really do? I don't know. I got to take a look at them. I don't know. Bankruptcy soon, near. Little wins over big time, adding up. Absolutely. Bro, I wish I learned how to take profits. I'm such a schmuck. I wish I learned how to take profits, bro. Like, I don't take profits. I'm an idiot, and I'm learning to do better. So yeah, little wins over time adds up. That's 100%. I don't know anything about Anchor. I'm just saying that all these token plays are the same. They all have the same exact narrative. All of them. 99% of the token plays have the same narrative. No, first it was any token play that had a dog. Then it was any token play that have reflections. Then it became any token play that offers any types of nodes as a service. All these token plays do the same shit. Copy, paste, rinse, repeat. Let me block this guy. Block user. So Saucer Swap sounds good because Saucer Swap actually has a use case. The Source token is, matter of fact, I might just buy Source token. Source token sounds like a good play, actually, to be honest with you. You know? So tokens that have a use case, like Source token has a use case, Cake token has a use case, Sushi token has a use case, Affinity has a use case. You know, those have use cases. I still have my A Nation. I have A Nation. Let me find this. Give me one moment, guys. Let me. Okay, let me share this. Stop, present, share. Boom, boom, boom. A Nation is good because they have somebody who's backing it, which is a Chuck Russell, who's the creator of the mask. What happens in the future, I don't know, but they got hit with this bear market and they can't find funding for their movies. That's the problem. So they kind of got clipped with that. But we'll see what happens. PBRs? Yeah, I'll pull it up after the live because it's about to start in a minute. But this looks good. I want to take a look at it.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's, around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex-housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. most forecasters and would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. You know, let's say inflation does come down much faster than we expect, which is possible. As I mentioned, you know, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, you know, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And, you know, transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. You know, it's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think, most forecasts, and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence
So
metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward?
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation, but that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
You know, so my forecast and that of my colleagues, as you will see from the SEP, and I mean, there are many different forecasts, but generally, it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. You know, if that happens, if inflation comes down much faster, you know, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down, into the somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if we get if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy saying, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, we understand, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainard said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses. Essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. In this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Ropp from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Yeah, man. In my personal opinion, I think that this is the first day that we don't have a complete collapse, and the first day of a very, very long road to come that we can possibly see the end. I think, as Daniel was saying, once the Federal Reserve stops raising interest rates and the federal funds rate becomes a little bit more normal, so to speak, then I believe this is when leverage is going to come back, and we're going to be back in this crazy-ass cycle where people are borrowing money to buy everything. Everything's going to go through the freaking roof. It's going to go through the roof for the next year or two, and then it's going to come back down. The interesting thing is, just logged on, are we up or down? The interesting thing is, bull markets last longer than bear markets, right? And that's what you have to pay attention to. Guys, is there any questions, anything that I can go over? If not, I got to get out of here. I have a personal thing to do right now. And I appreciate all of you guys. Please take a moment to like, share, and subscribe. It really does help my channels grow. And yeah, thank you very much. Have a great day.